Dear all, this is the first NBIM talk after I started as CEO in September. I of course would have liked this to be a physical event, but in times like these, digital ones are the best option. NBIM talks are an important part of our communication and transparency strategy, and we will continue to use this platform going forward. As a fellow fund manager, I have followed the fund from the sidelines for many years, and I'm in awe of what the fund has achieved. So many things could have gone wrong, but they didn't, thanks to hard and diligent work. Now, after 2 months as CEO, I'm even more impressed. We have a fantastic mandate and a great group of people working for the fund. In the first half of 2020, we have published several historical review documents which highlights important aspects of the fund. Today, we publish another review, Investing in the Equity Market. I hope these historic reviews in general, and today's talk in particular, can contribute to the knowledge about the fund and our investment strategy. My impressive predecessor and former CEO, Yngve Slyngstad, is the editor and driving force behind this. I hereby give the word to him. Yngve, the floor is yours.
Welcome to another NBIM talk. This talk is about investing in the equity market. It's about buying and holding the whole global equity market. It's not about buying specific companies. As an asset owner, you want to gain exposure to the whole of the equity market and capture the market exposure and the equity risk premium from that holding. And when we do this, we of course do it in scale. NBIM has gone from being a small investor to one of the largest investors in the world in a span of just 2 decades. Today, we own around 1.5% of the world's listed equities. And the topic for today is about how we went about doing that and what it entails to buy, hold, and lend equities in a scale like that. So our first job was quite simply trading, converting oil barrels into equity exposure. And with me today, I have Emil Framnes, who is our global head of trading, responsible for trading in all our equities, but also our other asset classes. So, Emil, I guess people are wondering how you do this job. And when they hear that you're trading equities for an average of $1 billion a day, and there's an average of 100,000 trade tickets a day, I think they would like to have some kind of insight into how that actually works in practice.
Yeah, thank you, Yngve, for having me. That's a very good question. And for me, it all comes down to that we have a fantastic team. We are present in all the local markets in our major offices, and we're truly able to understand how the markets work and then actually being able to implement all of this flow.
So, as a small team, not only is it relatively few people, but it's been stable for the last 10 years. So how have you been able to ramp up the volume and without increasing the number of people?
Yeah, that's a good question. As you mentioned, we do almost 100,000 trades a day, and for a human, that's obviously not possible. So to do this, we're highly IT dependent, and also dependent on having a very good operational staff. And we also use a lot of electronic algorithms to actually help us trade directly on the exchange, where we do not actually have to physically trade every single trade.
So, you know, most of investment people think about getting as high return as possible. Here it is about getting as slow detraction from return as possible. And, you know, our total trading costs can be 600-700 million in a year, but a very, very small portion of that is commission. It's actually market impact. So how you trade efficiently is really the game.
Yeah, no, that's true. And regardless of how you look at it, to trade is very costly, especially for a fund our size. And the cost that you are talking about, that is in addition to the commission and the taxes, is what we call the implementation shortfall. Basically, what we measure there is that we look at what the price is in the market when we want to buy or start our investment decision, and comparing that to the average price that we achieve when we trade over time. And as you mentioned, that cost can become very high, especially when we look at the cost of doing the whole investment decision.
So, you know, this is not what people, at least most people, think about as the typical job in finance. It's, of course, very IT dependent, and your own background is in math, and we're thinking about it differently. But you can't just think about it in terms of building systems. You have to somehow develop a strategy as well.
Yeah, no, exactly. The role is very diverse. You are a classical trader, and that itself has changed over the years. But then you're also a short-term portfolio manager given the size of our fund. And also, as you mentioned, we have to be very IT competent and be able to make sure that we fine-tune these systems to optimally make sure that we are able to execute. The strategic part that you mentioned is something we talk a lot about in the book that we try to explain. I think the common theme with all of our strategies is that we need liquidity. And basically, we talk about how we actually source liquidity, meaning on how we actually buy the shares or actually where we do the selling. And again, it's something we spend a lot of time on in the book.
You know, I think our starting point was slightly different from most other funds, quite simply because we were buying the whole market at the whole time. That meant that we were actually mainly doing program trades. At least a very high portion of our trading at the early days were program trades and futures. And then gradually we also built up that single stock trading. But I think that to a large extent also made us build a different type of trading team. Young people straight from school, very quantitative, IT oriented, led us to do electronic trading very early. And you know, this has happened at the same time as the marketplace has changed dramatically. Much more exchanges, lots of people thinking about trading in a different way. So the game must have changed completely, not only because of our size, but also because the market has changed during the last 2 decades.
Yeah, definitely. And this is actually quite an interesting story when we wrote it down, because I think we really talk about what you said is that originally we were very dependent on the brokers. And given our small scale, that was actually not that easy. And as we grew, that became easier. But we also saw that need to be able to do things ourselves. And as you said, going into that electronic trading, actually going into venue analytics to analyze which venues we actually should be trading on, how to do that. And also, as we really grew, we actually saw that there is a need for us to actually also focus on working with the exchanges, the regulators, to actually make sure that the markets we operate in are available for functioning.
So talking about that, you had a talk with a person who actually started his own stock exchange this week.
Yes.
Maybe we should bring him in.
Yeah, the guy I talked to was Brad Katsuyama. He is the CEO of and co-founder of IEX, the New York financial-based technology company, and the operator of one of the world's largest equity exchanges, the IEX exchange. As Yngve mentioned, we actually knew Brad when he was a broker at the Royal Bank of Canada, and we worked with him quite extensively on venue analytics as early back in 2008. As mentioned, starting a stock exchange is not something most people do, so I asked him that, why he actually wanted to start his own exchange, and this is what he had to say.
So, I mean, it started back, I worked at the Royal Bank of Canada, and I ran trading, and I guess starting the financial crisis in 2007, I started to realize that it became a lot harder to trade. Quotes that I saw on my screen, I would be able to access those quotes in 2005 and 2006, and in 2007, I really just couldn't trade what I saw on my screen. And that really frustrated me. And in 2009, RBC gave me the ability to move over and to run global electronic sales and trading, which meant I went from managing a group of traders, human traders, to a group of computer programmers and network engineers and people that actually were designing the underpinnings in the market. And in that process, started to talk to clients and realized that a lot of clients had some of the same issues that I had as a trader. I remember, you know, some of my earlier meetings, in fact, meetings with Norges Bank, NBIM, where a lot of us, I think, shared a number of the same concerns, that it was becoming harder to trade in the market, and that implementation costs and the cost of trading were going up. And my team at RBC on the electronic side set off on this research project to really try to understand what was happening. It turns out that the stock exchanges themselves have started to change the nature of their markets. They started to sell high-speed data and technology. And it turned out that the largest consumers of their products turned out to be this class of trader, unknown to me at the time, but now commonly referred to as high-frequency trading, where high-frequency trading is anywhere from 50, 60, 70% of the market. Some high-speed trading is good for the market making and arbitraging ETFs against the underlying stocks, et cetera. And some high-frequency trading is bad for the market, things like latency arbitrage. And I think from our standpoint, we wanted first to go out there and educate the buy side and investors on what we saw happening, in which we did at RBC. I packaged up a lot of this stuff and I brought it to the regulators. And I think it became apparent that it was going to be really hard to challenge a system, especially where the exchanges were kind of the dominant player and a big part of the regulatory conversation and there was nothing else to point to as an alternative model to what the existing exchanges were doing. And so the idea to start our own stock exchange, I think, came about in about 2011. And it kind of, led to me leaving RBC to start IEX with a group of people in 2012. And largely we did it to be a free market solution, to show that an exchange could be built in a different way, to show that exchanges could protect investor orders and could appeal on better performance, and could appeal to people by minimizing the advantages that other high-speed traders were getting from other exchanges. And I think over time, what that's led to is, IEX is, I think, the 8th largest exchange company globally. We'll trade anywhere from 10 to 12 billion dollars a day in trading volume, and we continue to grow. Just recently, we got approval from the SEC to launch a product called D-Limit, which is a displayed order that uses machine learning technology to protect investor orders or other people who are using D-Limit from things like latency arbitrage. And what that does is it encourages more people to display liquidity. It helps the price discovery function of the market. It lowers volatility if successful. And I think ultimately it's using innovation and technology to try to improve the experience for investors, for brokers, and for market makers, and to evolve the market in a way that does not favor one class of high-speed trader, but rather is kind of a balanced market that protects the interests of the fundamental investors who want to buy and sell stocks for fundamental reasons. So, it started as an idea. I think it evolved into a startup. And I think we're now at a phase at IEX where we're in a growth trajectory. And from our perspective, we feel very lucky to be in this situation. But it was because of investors like NBIM, I think, who gave us the confidence and the support that we needed to really launch this market and to continue to innovate like we do today. So what advice do I have for investment managers? I think, first and foremost, I think it's clear to us that institutional investors who really take the time to understand and to prioritize the importance of the trading process and to understand how to minimize their implementation costs, how to ask the right questions, and how to really dig into the products that they use, they will perform better than managers who don't. This is a market that is incredibly complicated, and the people who don't take the time to understand the complexity are the ones that end up paying the cost of this complexity. And I think the investment managers who do take the time end up saving their fund holders a tremendous amount of money. And in fact, it's unfortunately a market where the tax paid by larger investors is exponentially bigger. And so as a result, I think the diligence required for a lot of these firms, NBIM being one on the forefront, ends up becoming critically important to the whole investment process. And what we've seen over time is that more and more firms are engaging on market structure, not just kind of for their own benefit, but also for the markets overall. I think IEX has worked with investment managers to talk to regulators and to advocate and to support initiatives that I think change the nature of market structure to support investment managers. So not just, again, I think it's support on a firm by firm level to help their own fund holders and their own performance. And then it's support on a macro level to support themes and initiatives. Ultimately, the market is here to serve companies and investors. They are the two pillars of the stock market. And frankly, those pillars, I think, need to be a much more prominent and important part of the future for markets. And I think that's a reason why, NBIM has, one, had success in managing their implementation costs internally. Two, has become a great kind of partner for IEX to work through. But three, I think, is part of the future solution to where this market heads. The more sophisticated asset managers become and the more engaged they are in the market structure discussions, I think the better off we all are.
That was Brad Katsuyama talking about trading and exchanges. Let's move to another topic here, and that is how we are holding and maintaining our market exposure. So with me today, I have Geir Øyvind Nygaard, who's our Chief Investment Officer for Market Exposure Strategies. So Geir Øyvind, this sounds like quite simple. The traders have already bought in the global equity market and you're sitting on it. And that basically means that you don't have to do much.
Oh, thanks, Yngve. So, well, if it has only been that simple, no, the market continuously evolves, right? We have new companies being listed, we have companies being delisted, we have companies being acquired, and so on. And the index that we follow, that kind of mirrors that and also reflects those changes in the market. So if you actually look at it in the portfolio that we hold today, there's only around 1,000 of the companies that we hold that was actually part of our portfolio in the first years.
I think people will be surprised to hear that. I mean, we are holding more than 9,000 different companies, and you say that only 1,000 of them were there from the start.
Yes, and of course a big part of this came when we expanded into smaller cap companies and also emerging markets back in 2007 and 2008. But there are a lot of changes also on an annual basis. I would say that in a normal year, it's typically around like 600 to 800 companies that are either going out of the index or coming into the index.
So just the numbers there. So the FTSE index that we're following, the world index is roughly 8,000 companies, and up to 600, 800 of those are actually going in and out every year. So 1 out of 10, basically.
Yeah, exactly. So, and on top of that, you have a lot of smaller changes that affect the weighting of each of the companies. So the index is a very dynamic target. So it does require a lot more work and a lot more turnover and trading than I think what most people appreciate to actually track this index exposure.
So what do you say is actually the main choices that you have to make? Because there's a lot of small changes all the time. New companies come, there's corporate actions, different changes to the marketplace, and you want to own the whole thing. But what kind of actual factors decide what you're doing?
Yeah, no, it's a very good question. So in my view, clearly the most important choice is how you actually balance or trade off the trade cost that you will incur versus the relative risk or your relative risk tolerance. So we are, of course, a big fund. Trading is costly, especially for a large fund like this. So we put a lot of emphasis on reducing our transaction cost, even if this means that our relative risk or our tracking error increases.
So I sometimes say that if you want to be good at indexing, you can't take the index too seriously. And also, when you sit and look at it, ideally you would like to actually sell shares who's going into the index and buy shares who's going out, because there's a certain shift in the demand-supply curve for those shares at that time. So kind of joke aside, but would you say, in a simple way, what is it actually that describes NBIM's approach to indexing? Is it really just traded cost evaluation?
So that's a very important part of it, of course. And what we try to do there is basically we try to forecast how the index will change many months into the future. And we're also very patient in how we actually implement. When we try to implement a change, we do it in a very patient way. So we can use months to do it, right? And in that way, we can use a lot of the opportunities that we see in the market. But that said, I think that the most important decision that we made was really to have the ambition to outperform the index. And we do, as I said, the first part of that is kind of fairly straightforward, right? So we know that there are some pitfalls with index management, and we just try to avoid them. But I would say more importantly than that is that we try to systematically put on some or have some enhancement strategies that we think will increase the return over the long term.
When people are referring to enhanced indexes, it's really about two things. How do you create excess return in all these market changes who's coming the whole time? And how do you avoid all the pitfalls from just doing straight replication? Exactly. Maybe we should bring in one of the guys who's doing this on a day-to-day basis.
Yes, let's do that. So with us today, we also have Per Einar Ellefsen. Per Einar, he joined NBIM back in 2014, and he's also headed up our index management for several years. So, Per Einar, can't you explain a bit more of what type of strategies or what type of enhancement strategies you and your team utilizes?
As you know, we actually insourced the index management in 2001. And one of the main reasons we did this was that we thought that we could achieve better results through active enhancement strategies internally rather than using external managers for this. And one of the main enhancement strategies back then was actually index rebalancing. It was necessary because we had to think actively about how we should time the implementation of each index change and improve our outcomes. We also engaged very actively in relative value strategies, which challenge us on how we should position the portfolio and use the available liquidity.
But I think it was one thing kind of back then. The fund was relatively small. Over time, it's grown to a very large fund, right? How is the strategies evolved with time and as the fund has grown?
Yeah, and the index portfolio really has grown tremendously. I mean, it's multiplied by 5 since 2008. But we moved from being a small index fund to being a large equity owner, and we give an increasing focus to when and how we become long-term shareholders. One example of that is through capital market strategies. The equity indices tend to include new companies that come to the market only 9 to 12 months after they're listed. But we prefer being actually early investors at the time of the IPO instead of buying the shares when other passive investors do at a later stage. So we've increased our activity in ECM over the last 5 years and participated more broadly in block placings from other investors as well.
Okay, so we have a global team. So we have both portfolio managers and analysts in all our regional offices. How do you utilize that? And does that mean that you kind of tailor the strategies to the different or in the different regions?
Definitely, we do. We have presence in all regions, right? And we know that ESG is a very important topic for the fund. And what we learned from our local presence in emerging markets in Asia was that there were a certain number of companies that benefited from regulatory differences to manipulate their earnings. They saw tremendous price rises, and then they were included in the major equity indices. So this poses a significant challenge to us as an index-based investor and led us to take an active stance on these companies. We prefer to let the portfolio become underweight the companies when they were included in the index, rather than taking the risk of investing significant amounts of capital in them.
Okay, just lastly here, can you also explain a bit more in detail kind of how the different teams or how your different teams operate and kind of manage this responsibility?
Yeah, as you said earlier, we focus on achieving the best possible return, and the investment team really reflects this. It's a high-quality team, and we delegate investment mandates to let the portfolio managers manage parts of the index portfolio. So each index portfolio manager basically manages a portfolio of around 1,000 companies. In addition, they work very closely with the local trading teams, the lending teams, the operations, and the systems teams to achieve the best possible results for the index portfolio.
Great. Thanks a lot, Per Einar. Thanks for joining. Always nice talking to you.
So that was discussion about how we do index management or market exposure strategy, as we call it. So we covered now how we're buying the world equity market and how we're holding the world equity market. But in the book that we're publishing today is actually a third leg, because we are using our holdings, our inventory, as we call it, and lending it out to try to eke out a bit of extra return from there. So with us today, we also have Matt Brunette, who has, for the last 2 decades, since we started, headed up our security lending activities, which is an investment strategy that many people overlook in the market. And Matt, I think many people wonder, when you are lending our inventory, lending our shares, who's actually on the other side here?
Yeah, sure. It's mostly hedge funds, but we don't really know who they are. We lend to roughly 24 banks who then on-lend those same shares to their hedge fund clients. So on average, we have approximately 400 billion kroner in equities out on loan in 35 markets across the globe. So that means that literally these shares can end up in the hands of thousands of individual investors across the globe.
And we don't really know who's on the other side, do we?
That's correct. So we have intermediaries in the process, both agent lenders and prime brokers. So we know that the demand primarily comes from hedge funds to satisfy their short sales, but we don't necessarily know who they are.
So Matt, you've been doing this for us for 2 decades now, and it's been very profitable, but of course it has changed a lot during those 20 years, and to continue to keep the return, you have to change the whole time.
That's correct. When we started doing this 20 years ago, the old industry norms were you would lend your large liquid shares in developed markets, you'd create a base of income from there, then you'd enhance that income from reinvesting your cash collateral. We didn't really spend any time on these things in the beginning. At least we managed them very conservatively or passively. What we did focus on was new things. So we spent a lot of time on developing new markets, new counterparties, new collateral types, and even new routes to market.
So I think the book that we're publishing today is actually laying out quite nicely all the steps we have been doing to continuously be one step ahead of the market, because margins here seems to go down the whole time.
Yeah, that's a problem. So, but I would say this base layer, the old traditional make your shares available then do nothing, that's gone down. But there's plenty of interesting things that keep popping up. So, as a fund that invests in 70-odd markets globally, our biggest emphasis would be let's make a yield on all our assets. Let's develop those emerging markets.
So when I look at it, we are lending in a year like this, I guess it will be around 6% of our inventory on average. We're making maybe a 5-6 basis point of that. So on average, you actually get 1% revenue on your lending activity. But that's because we are lending shares that are quite sought after. And still, when I look at it, there's a huge variation in the fees we're getting. How come there's so big changes here?
Sure. So in securities lending, we call those specials. So at any given time, there can be quite intense investor demand for individual companies or market segments. But the supply of those securities is constrained. So typically, this happens in emerging markets where you have operational frictions, or in small cap securities where, by definition, they're just small. But anyways, we don't really lend at very small margins or very small fees because we recognize there's risk in these transactions, especially tail risk. This manifested itself with Lehman Brothers in 2008 and nearly again in March of this year.
Mm. So when I look at it, currently we have a cutoff of 25 basis point, as we say, or 0.25%. We're not lending for less than 0.25% because we recognize there is actually some risk there. And that means that you actually have to do risk management. And risk management, the simplest form is to get someone to guarantee it, like we did when we had an outsourced arrangement with our custodian. But today it's mostly about managing collateral. And for me, this looks a bit like what I call portfolio management in reverse. You kind of have to take a really care look at your portfolio collateral and think about how that is working in the most severe and adverse market circumstances.
Sure. So like any investment strategy, risk management is quite important. But still, innovating our product is key. And there's other considerations as well. We need to think about our equity ownership. How do we vote? How do we manage relationships with both counterparties and with companies themselves? So we can control risk through counterparty evaluation, through bank guarantees, as you say, or just through good collateral management. But we still need to innovate. And we actually view risk management as innovative. So when we're managing this tail risk, what we do know is we definitely can't do the same things everybody else is doing.
So, Matt, you've been innovating here for the whole time. You don't have a very young and small team. It's just 4 of you. And when I look at the returns of 40 billion kroner, that should be around 10 billion of each of you. So certainly been very profitable and very worthwhile. But I think the message for everyone, I think, is very simply this. Take a careful look at the lending activity in different funds, because it's much more entailed there than I think most people think about. And it's an overlooked part of the investment strategies that you have to do if you're managing for equity market exposure. So let us round up this. Today, actually, we're coming out with a book about investing in the equity market. This is about then buying the whole market, holding the whole market, and also lending our whole market exposure. The market is changing all the time. New companies come, there is new formats, there is new venues, there is, of course, all these things that will be happening. And you have in this process to make a series of continuous choices to optimize your portfolio. And in this process, of course, attention to detail is very important. What kind of systems you have, of course, is important. Your local market knowledge and knowledge of each and single one of these securities you're invested in. And in the final end, it is also the ability to think ahead about what's going to change and how is the marketplace going to change and how we're going to position ourselves for that. So change, that's what we do, and that is what we're going to do going forward. And if you want to read about how we have changed our approach to investing in the equity market for the last 20 years, pick up the book, look at our website, and you'll find it there. It's called Investing in the Equity Market. Thank you for listening in, and have a continuous and good day.